Sentiment is so bearish on bonds, it's actually bullish. That's coming up on 3 minutes on Markets and Money. Interest rates have been moving up here over the last few weeks, really because of concerns over rising inflationary pressures, the Fed hiking rates, and that's absolutely a normal response here. This recent surge in interest rates certainly has people concerned about their fixed income holdings, potentially the increase of rates as it continues to grow. And naturally, the response is that interest rates have to continue going up here forever because we have inflation. Well, that is true up to the point that you begin to get disinflation in the economy. Now, yesterday's article on the website talking about disinflation as the bigger threat really speaks to this point as we start to look forward, looking at slower economic growth, lower rates of inflation on an annualized basis. This is all going to start to create a feedback loop into what's happening with Treasury bonds. Also, considering the fact that the Fed is about to start hiking interest rates, that will also impact Treasury bonds from the standpoint that as yields go up, it begins to track foreign inflows of capital to chase the higher yield. To understand what I'm talking about, let's go back to the last time that the Fed was hiking interest rates into a strong economy, thinking that they had the ability to lift rates substantially because they were concerned about rising inflationary pressures. Now, this was back in 2017 where they started hiking rates, and sentiment on bonds was getting extremely bearish at that point and continued to get more bearish over the course of the next several months as the Fed began this rate hiking campaign. They were hiking rates, tapering their balance sheet, and then the realization set in that this was all leading to slower economic growth. In fact, in late 2018, the Fed said, well, we're nowhere near the neutral rate. And at that point, the markets began to convulse over the issue that the Fed was going to continue to hike rates. And there was already plenty of signs that there were stresses in both the markets as well as the credit markets, and the economy was starting to slow down. Immediately, that reversed the bearishness on bonds back into a bullish trend, and that was where people started flooding into Treasuries for the safety trade as concerns over the continued rate hikes by the Fed began to weigh on outlooks for both the economy and for the financial markets. Of course, stocks correcting by 20% at that time, and by the time we got to the end of 2019 and into 2020, we were already talking about much lower rates and a very bullish sentiment on bonds at that point. As rates have been coming up ever since the March 2020 lows, of course, stronger economy, $5 trillion in liquidity, stronger economic growth. It's interesting to see that rates really have not risen that much, yet sentiment on bonds is now as bearish now as it was back here in 2017, 2018. The Fed beginning to hike rates. Certainly doesn't mean that rates can't go a little higher here, but we're starting to get to the point to where those yields are going to start to attract foreign inflows of capital into Treasury bonds. Also, we're getting to the point to where yields are going to start to impact economic growth, slow inflation, and put the Fed back into a defensive stance. Again, as we continue to watch here, yes, yields have certainly risen. We're back to where we had these previous resistance levels back in September of 2020. But again, we're getting to the point that this is going to be a contentious area for the Fed to try to hike rates into a slowing economy when you start to see disinflationary pressures. And if the market does indeed begin to buckle here because of tighter monetary policy, we're going to see the sentiment on bonds go from extremely bearishness to extreme bullishness as the flight to safety begins to take root. I'm your host, Lance Roberts, for 3 minutes on Markets and Money. See you back here tomorrow.